New day, new learning. We are ready to roll on our next session of stock investing basics. But before that, a quick reminder that this video is part of a series of basics of stock investing intended for new and beginner stock investors. In today's video, I'll be going through some of the key financial ratios that are used in stock analysis. If you're new to this channel, I highly recommend you watch part 1 of this series where I go through the basics of fundamental analysis. I'll leave a link down in the description. It's a great precursor to today's topic and will help you get a logical flow of the subject and understand the fundamentals a bit better. Nevertheless, a quick recap. In our previous session, we touched upon qualitative and quantitative fundamental analysis with further emphasis on financial statements. Today, we will look at some of the key financial ratios derived using the variables from the 3 financial statements. You will see how they all come together when we look at the calculations. Right then, let's crack on, shall we? While there are several financial ratios you could use to analyze the stock, as a beginner, it's best to stay away from the Pandora's box and stick to these 6 key ratios: EPS, price to earnings, price to growth, price to sales, debt to equity, and return on equity. Let's start with the most popular ratio, EPS, or earnings per share. EPS is a ratio to gauge a company's profitability. To calculate EPS, preferred dividends are subtracted from company's net profit and divided by the number of outstanding shares. Well, I'm going by the assumption that you probably know there are 2 types of shareholders to a public company: common shareholders and preferred shareholders. Since preferred dividends are mostly guaranteed, unlike dividends to common shareholders, it's a standard practice to subtract them from the net income. Preferred stock can be found as a cash outflow item in the financing activities section of a cash flow statement. The net profit can be found in the bottom line of an income statement, and outstanding shares can be found under shareholders' equity of a balance sheet. EPS shows the company's earning capabilities and allow you to gauge its value. So naturally, higher EPS can lead to higher share price, which is a positive for investors. However, EPS on its own has a few limitations. If a company decides to buy back its own shares, leading to fewer outstanding shares, then the EPS can inflate without actual increase in its profits, giving you distorted figures. Also, EPS does not take into account any debt, and therefore EPS is best used in conjunction with other metrics in assessing a stock value. Which leads us to the next ratio, PE, or price to earnings. PE ratio is the share price of a company divided by its EPS, or earnings per share. So what does this mean in layman terms? Well, don't we all want cheap stuff? So why not cheap shares? Well, cheap doesn't mean garbage. We need quality for a good value. But how do we know what good value is? And that's what PE ratio helps determine, if a stock is worth its current market price. Let's look at an example. Suppose company A is trading at $10 per share and its EPS is $1.50. Its PE ratio will be 6.66x or times, also referred to as multiple. What this means is, if you pay $10 to buy this stock today, you are paying 6.66 times of their yearly earnings. In other words, it will take you roughly 6.5 years to get your $10 back. So, should you buy the stock? Is it cheap? Well, that's the catch. You cannot look at a company's PE in isolation. The only value add of PE is if you compare it with the PE of another company. But that's not all. There's another catch. Comparison has to be apples to apples and not apples to oranges. There are 3 possible ways to compare a PE ratio: against its peers, against the industry average, and against its own historical PE. Let's simplify this with an example. Suppose you want to buy a tech stock. First, we look at the industry average PE. Let's say it's at 18. We then pick a tech stock, Google for example, with a PE of 13 and Microsoft with a PE of 11. Let's also throw in another hypothetical upcoming technology company called ABC to the peer list, whose PE is at 40 for instance. Now, On the face of it, we could say Microsoft is cheaper than the industry average as well as its peers. So you would assume it's a good buy. However, it's not conclusive because there could be many reasons why a PE of a company is lower. It could be because it's genuinely undervalued, or perhaps signaling something amiss like organizational restructures or price wars, etc. Therefore, investors should further compare the PE of a company with its own historic PE before buying a stock. They could also go a step further and compare the PE with the benchmark index if the stock is part of it. In our example, Microsoft is part of S&P 500. So comparing its PE with S&Ps will further validate if the stock is actually cheap. There is one more puzzle. So are stocks with higher PE ratio always bad then? In our example, ABC, the hypothetical tech company, has the highest PE. Just based on that, it might seem obvious to dismiss it straight up. However, higher PE doesn't always mean it's bad. If a company has a revolutionary idea or a game-changing concept, its PE could be much higher than the industry average and its peers due to the fact that the market is expecting rapid earnings growth, providing high returns in the short term, justifying a high PE. So in our example, if ABC has a disruptive idea that could change the world for the better, then some investors may find value in investing in it despite its high PE, as they expect to get their money back much quicker than 40 years. So in a nutshell, while PE is the best approximation available to gauge the value of a stock, it's imperative to have a bird's eye view to avoid any possible traps. Moving on, PEG or price to growth ratio. This is an extension of PE ratio targeted particularly at a stock's future growth prospects. While PE ratio is based on historic metrics, PEG ratio considers a company's future metrics with regards to its growth. PEG ratio is calculated as PE ratio divided by EPS growth. Let's look at an example. Suppose stock A's PE is at 18 and PEG is at 1.1. and stock B's PE is at 25 and PEG at 0.8. Due to its low PE, stock A might seem cheaper to buy. However, PEG ratio suggests stock B has better projected growth rate. What's the point of buying a stock with low PE if the company doesn't grow in value, right? So, based on its lower PEG, stock B may be relatively a better buy in relation to its projected growth even though it has a high PE. Typically, a lower PEG ratio of less than 1 is considered favorable. But it must be noted that a PEG ratio is only as good as its estimation. So if future predictions are not accurate, then PEG can be unreliable. Next, let's look at price to sales ratio. This ratio shows how much an investor must pay to buy one share of a company relative to its revenue from sales. It's calculated by dividing the stock price by sales per share. For example, if a company has $600 million in sales with 300 million shares outstanding, its sales per share would be $2. Suppose the current stock price of this company is $10. The price to sales ratio is 5. This suggests investors are paying $5 per share for every dollar the company makes in sales. Quick note, price to sales takes into account only sales revenues and not profits or cash flows. So, it's useful when comparing stocks of companies with little or no profits or even with negative cash flows. Amazon is a classic example. Its price to sales ratio between 1998 and 2003 went from 40 to 1.8, while it was still massively unprofitable over this time period. As a result, Amazon would have been a value buy in 2003, just based on its improved PS ratio over the preceding years, even with terrible losses. And history shows it sure was. The stock has appreciated multi-fold since then. So, price to sales ratio can be effective in evaluating growth stocks that have either suffered a temporary setback or yet to be profitable. Point to note, Like any other ratio, price to sales ratio is best compared against similar companies within a sector. As a general rule of thumb, lower price to sales is considered a more favorable investment. However, moderately high PS ratio can sometimes be good value for a strong company, like in the case of Amazon as we just saw. So, price to sales should be considered in tandem with competitive advantages and companies' growth prospects. Next, debt to equity ratio. This ratio measures companies' total debt in relation to shareholders' equity. It is derived by dividing total liabilities from shareholders' equity. These both are found in the company's balance sheet. A high debt to equity ratio indicates either the company has more debt than its revenue, or it's leveraging its assets to finance growth, thus increasing profitability. If the debt leads to increased earnings, then it's a positive sign. But if the debt is weighing the firm down, then it's not a favorable investment. So, a good debt to equity ratio is highly contextual based on a company's overall profitability and its performance. And finally, return on equity. This ratio measures a company's ability to generate profits from the money that shareholders have contributed. It is calculated by first subtracting preferred dividends from a company's net profit found in the income statement, just like we did when calculating the EPS, and then dividing by shareholders' equity found in the company's balance sheet. It shows how much profit each dollar of common shareholders' equity generates. Let's quickly look at an example. Suppose Company A reported a net income of $120 in the last financial year, and it has issued preferred dividends worth $10,000 and the shareholders' equity is $50,000. Its return on equity is 2.2. This shows the existing shareholders saw a 220% return on their investment. So, ROE tells potential shareholders how efficiently their money will be used by a company to generate income. It is based on shareholders' investment rather than the company's investment. Unlike all other ratios we just covered, ROE is considered better if it's higher relative to its peers. And so we are nearing the end of this tutorial. Quick pointers before we wind up. Investing decisions should not be made on the basis of a single ratio. And like I emphasized throughout the video, the ratios are best compared against its peers, sector average, and its own historical performance and valuation. Now you must be thinking, that's way too many calculations and quite daunting. The good news is, in reality, you really don't need to calculate any of these ratios yourself. It's all readily available on the internet. But I always believe when you understand how something is done, it helps to make informed decisions. On that note, if you found this video useful, please do consider sharing it, because financial literacy is an investment and sharing is caring. See you in the next one. Take care.